Okay, as it pertains to the income statement, we are in Unit 2.3, Cost of Goods Sold. This is a super important component of the income statement and would be important to any operating business budget in 2017. The cost of goods sold, what is it? It's an accounting concept for sure, and it allows businesses to calculate on the income statement specifically for buying and reselling goods. A lot of business buy and resell goods. That's just what they do, different types of product. That's called the cost of goods sold. Hence, it's a single number on the income statement. The cost of goods sold is the actual cost to the business. What are they using to produce goods that they sell? Well, various things, but nonetheless, they have a price. But let me discuss something. Not all businesses buy and resell goods. Some businesses, such as doctors and lawyers, what do? They sell services, not goods. So on their income statement, they would not calculate the cost of goods sold. You may see that again. But businesses such as manufacturers always have cost of goods sold. And there's three amounts, for instance, that a manufacturer would use. Number one, materials. What does an owner need to create the product? Well, raw materials, resources, labor costs. We have people on the payroll, but what essentially are other labor costs? A manufacturer, well, you have machines. You have factories to produce the product, to sell and produce these goods. Also, you have overhead. You have a facility, you pay rent on it, you lease it. A machine breaks down, you need to repair it. Also, supplies. It could be a small business, it could be a box of pens. It could be a large business, it could be 10,000 desks. Cost of goods sold have two formulas, okay? And they're determined by beginning inventory plus net purchases minus ending inventory. However, it's very important that businesses are careful not to what's called, and you will see this again, overstate their inventory. Nor do you want to understate your inventory. Documentation is key. You want to be meticulous in detail. How much of a good are you selling? How many do you have stored away? How many are you selling? Are you able to keep up? It will have a severe effect on the net income and the cost of goods sold. So let me give you an example. At the end of Dugan Realty Corporation's first year of operation, it was determined that the company had overstated its inventory. The effect that the overstatement will have on first-year cost of goods and net income, in this case, occurred where the cost of goods sold were understated and the net income was overstated. Hence, an imbalance That's no good. Here's another example. Larry. Larry's an accountant. He's at a publicly traded corporation. He recently discovered in the accounting records that a material error affected last year's financial statements and will affect this year's statements if the error is not corrected. However, it will reverse itself and probably no one else will discover it. Even though last year's net income was materially overstated and this year's net income will be materially understated, the overall effect on the 2 years' combined net incomes is that the overstatement and the understatement will completely offset each other. Which of the following, however, best action should Larry take? A, should he do nothing, since no one will be harmed of the offset? B, immediately inform a local law enforcement agency? C, place a phone call to the local newspaper to inform the public about the error? D, immediately contact the Security Exchange Commission with the federal government, since his supervisor wasn't sure what action he will take? Or E, simply inform his immediate supervisor and help correct last year's statements? Well, the correct answer is E. So, now we're talking about gross profit formula that directly affects understating and overstating. Here it is. You will see this again, so let's note it. The gross profit formula is as follows. Sales minus our focal point for the unit, cost of goods sold, will equal gross profit, otherwise abbreviated GP. Here's an example. If net sales are $2 million and operating expenses are $300,000, and your gross profit, after all is said and done, is $360,000, how much is the cost of goods sold? Well, using that formula, I present to you, is it A, $340,000, B, $660,000, C, $1,640,000, D, $1,700,000, or E, $2,660,000? Well, actually the correct answer is C, $1,640,000. Sales minus cost of goods sold will equal your gross profit. Follow that formula, you will be fine. Now, we have an income statement formula. Very important. What exactly is the formula for this? It's fairly extensive, but rather familiar in part one. So, we have sales minus costs of goods sold equaling gross profit over gross profit equaling your net income. And there you have it, cost of goods sold.